In this video, we're going to talk about SoundHound. They recently had a moment where their stock took a hit due to a share offering they scheduled. Basically, they filed paperwork to sell more shares 3 years from now, which can be seen as bad news because it dilutes the value of existing shares. However, let's dig deeper into the story and also look at the technical aspects of the stock. Remember, it's not just about the stock itself, but how you trade it that can make it successful. You could invest heavily in a winning company like Apple when it's at $200 per share. But if you trade it poorly and sell when it falls to $145 per share, you could turn a winning scenario into a losing one. The same could be happening with SoundHound right now. Let's dive into the details and see what's going on. Let's talk about a stock called Sound AI and their recent share offering that caused the stock to drop. The speaker had been keeping an eye on the stock and was waiting for a pullback before buying in. They decided to target a price around $3 per share and used a strategy of buying in small increments to get a better average price. As for the stock itself, Sound AI is in the AI artificial intelligence industry, and it has been performing well with a significant increase in revenue. Their earnings report is coming up, and the speaker believes they might have positive news, which could drive the stock price higher. Regarding the share offering, we think the company is raising capital strategically to take advantage of the AI trend and potentially increase the company's value. Also note that the company is not financially struggling. In fact, they have a good amount of cash on hand. In summary, we can see the share dilution as a positive sign for the stock, given the company's strong performance and potential for growth in the AI industry. However, they acknowledge that there could be other factors at play, and they are basing their analysis on the available charts and fundamental information. SoundHound stock had a double top rejection at $5, which is a bearish signal. Additionally, a bearish candle with a big wick appeared at the top, suggesting the stock might not go higher. The stock is heading for an extreme oversold position, meaning it might drop further. These companies will showcase their AI capabilities in their upcoming earnings, which could lead to a positive impact on their stock prices. For Google, if the earnings are great and the stock price goes above $127, it would be a confirmation to hold on to the investment. However, if it doesn't break that level, it might signal a sell. For Microsoft and Snap, I'm a bit cautious about Snap's performance, but if their earnings beat the market and the stock price rises above $13, it could potentially double. I'll keep a close eye on Snap and decide if I should invest based on how they perform after the earnings report. Overall, I'll wait and see how everything unfolds with their earnings and stock prices to make a decision on my trades. Let's dive into the technical analysis. Currently, it looks like the next support level for the stock is at 2.34 cents. I personally think it might break through that level and possibly go down to $2 or even as low as 1.95. If it reaches $2, I'm getting excited about owning this stock because after that, there's a potential opportunity for reversal. We're in a wedge pattern with resistance at $5. So, my trade strategy is to wait and watch. If it drops to $2, I'll enter a small position, spreading my purchases over time, and try to make the largest purchase at the bottom. This could be a profitable trade with a potential gain of up to 150% if it goes back up to $5. There's some exciting news about Alibaba. I think Alibaba is going to do well. It's one of my big plays, and I've mentioned it before. While many people are trying to buy into the top of the big tech rally, Alibaba has been running down, but it's still a great company with strong leadership. The news story is a confirmation that Alibaba has a lot of upside potential ahead. It hasn't taken off yet, so if you're looking to invest in a stock that hasn't reached its peak and still has room to grow, Alibaba might be a good option.